So what's going on, you guys? My name is Rafael. I am the host of the Stamper Podcast, where we help notary entrepreneurs grow their business. We have an awesome guest on the show today. We have estate planning and business law attorney, Patrick Elahmadie. Good afternoon, Pat. How's everything going?
Hello, I'm doing well. Thanks for having me. How are you?
Man, I'm doing awesome, better than I deserve. Before we proceed, I got to tell the people tell our audience a quick story about how we first got connected. We met at a BNI meeting. I was invited by, I believe, Jake Murray. He's a real estate agent with Redfin. He knows that we focus on serving estate planning law firms. So he said, we're going to have an estate plan attorney in the meeting. I think you should really come. So I said, cool, I'll make sure to be there. Lo and behold, we come to the meeting, got a chance to meet Pat. Had a couple of minutes to talk shortly, but then we ended up setting up a one-on-one. Got to learn a bit more about who's his ideal client, referral partners, how he gets business. And I wanted to get him on the show today because we've done multiple signings together. I see the work that he puts in, the time that he spends with his clients, making sure that their questions are answered, and just creating an overall positive experience. And so I wanted to get you on here today to highlight your business and let the people know about what you bring to the table.
Well, thank you so much, Rafael. I really appreciate that. I appreciate the kind words. And as I'm sure your listeners know, you are incredibly good at your job, very professional, very available. You've helped me navigate a couple tough situations, and you've always been there, sometimes last minute when I needed you. So thank you for your work and for all you do.
I appreciate the kind words. So let's get right into it. So we know you're an attorney, man. Just give a brief story of what attracted you to becoming an attorney.
Sure, yeah. I was actually pre-med until my junior year of undergrad. I thought I was going to be a doctor. I always wanted to be like my uncle. And then I took a hard look at myself and what I was good at and what I enjoyed. And I thought that a lawyer would probably be a better fit. I love words. I love people. I love logic, kind of the underlying math of it. And the more I learned about the LSAT and law school and how it all works, the more I was attracted to it. And so I decided to pivot, and I started studying pre-law and studying for the LSAT. And I have not looked back since. I really actually enjoyed it. I don't know if that makes me strange. I know a lot of colleagues of mine did as well. And law school was really interesting. It taught you to think about things a little bit differently and kind of untangle things in an interesting way and view things in an interesting way. So since then, I haven't really looked back. I've always been interested in business and kind of the corporate wealth protection side of it. A lot of law school is geared towards litigation. I kind of knew from the beginning that wasn't really my style. I'm more about kind of cooperative things. So, in business, when you're doing a deal, usually at the end of the deal, the two parties are going to have a continuing relationship. And so it kind of changes the whole approach to negotiating a deal, because you really do want both sides to be happy. You're not trying to crush the other side. You're not trying to leave with the absolute most to the detriment of the other party. No, you're trying to create something sustainable where both parties are invested in growing it. So I really like that aspect of it. I started working at a big law firm down in San Diego called Mintz Levin. I started working in their corporate department, and I was lucky enough to represent clients across the whole business life cycle. So I help people start companies, forming LLCs and S corps. I help them with fundraising, whether it's safes or Series Seed, Series A through Z, convertible notes, some contract drafting. And then I also did some M&A work, and I even represented a few public companies through IPOs and public reporting, drafting 10Ks and 10Qs. So throughout my whole experience, I really got to see the whole process start to finish. And I really enjoyed it. I enjoyed helping local entrepreneurs that, know a lot about their business, know almost nothing about the law, kind of set them up in a way where in a way that's sustainable and in a way that lets them negotiate against or, with large investors to end up with a deal that works for everyone. I really enjoyed that. After that, I went in-house at a large automotive group, very large automotive group, like $1 billion a yearly revenue, 500 plus employees. I was their general counsel overseeing all legal matters, and boy, were there a lot of legal matters. Incoming and outgoing, buying dealerships, selling dealerships, working with manufacturers in the DMV, overseeing litigators that dealt with a lot of our incoming and outgoing lawsuits. And it was a terrific experience, definitely. But I always knew at some point that I wanted to do something on my own. And so after a couple of years, I felt like I had built up enough experience to start something myself. And that's what I did. I moved back to the Bay Area. My whole stint from law school through that in-house counsel job was in Southern California between San Diego and LA. So I was able to move back to the Bay Area, open up my own firm, doing business law, but also I picked up estate planning on the way. So I spent several months pouring through every treatise I can get my hands on and forming relationships with other firms that have been working on estate planning matters longer than I've been alive. So I built this kind of ecosystem where I had what I needed to do the work, and I had the backup to help with anything that I wasn't, capable of handling at the time. And now I think I've built a nice practice. It's probably 75% estate planning, 25% business law, but it's nice because I have so much experience in both, and I can make sure that they both play well together. They both kind of center around wealth protection, peace of mind, planning for the future. So from a business perspective, it's all about kind of limiting liability and setting up your business in a way that lets you flourish in the way you want to flourish, whether that's, if you're looking to get venture capital, maybe it's forming a Delaware C Corp that you can grow and, grow the box and eventually sell the box. Or if you're kind of a local entrepreneur that wants to run a more mom and pop cash cow kind of thing, maybe an LLC is what makes the most sense. Some type of pass-through entity that allows you to report everything at the end of the year yourself. And there's a number of different approaches. And then on the estate planning side, the name of the game is avoiding probate. That's kind of the number one reason why people do it. Once people find out what probate is, they want to avoid it at all costs. And for listeners that might not know about what probate is, it's basically the process after you pass through which a court decides what happens to your stuff. And that's a process that can take at least a year and a half, sometimes 5-10 years, depending on how many competing claims there are, throughout which your assets are frozen for the most part. And there's mandatory attorney's fees that are calculated as percentages of the estate. So on $1 million estate, you can end up spending maybe 50 grand in attorney's fees, executor fees, court fees. It's very expensive. It is time consuming. It is more stressful for everyone involved. And it is somewhat easily avoided. The way you avoid it is usually the most efficient way is to set up a trust and move enough assets into that trust so that what's left outside of the trust is below the probate threshold. So this year in California, the threshold is $184,500. So if you have $184,500 worth of stuff that is not either in a trust or in a POD account or some other way of transferring it, then you are going through probate. So it's helpful to know what you're up against, to know how to navigate it, and to think of it as an investment. It's setting up a trust and all the related estate planning documents costs a few grand, and you're saving yourself, potentially 50 grand or more down the road. So, if someone came to you and said, here's an investment where you're going to get 20x return on your money, that's usually an investment you'd like to take. So it's kind of how I view it. And when you have an understanding of both the estate planning and the business side, you can create an ecosystem where it all works together. You can set up an LLC or a corporation. You can take the shares of that corporation, you can put it into the trust, and you can ensure both that you have limited liability and that you're avoiding probate at the same time. So it's a good thing to think about, whether you're an entrepreneur or whether you especially if you own any real estate, especially if you have any minor children. That's where you designate guardians for them, is in the estate planning documents. So a lot of important stuff happens between those two areas, and it's important to build yourself that kind of peace of mind where you can take care of it early and continue it, make sure it continues in a sustainable way.
So now that we know what estate planning is, why you should be very proactive about avoiding probate, I want to go back to what you said earlier. You said 75% of your business is estate planning, 25% business law. Can you share why we're seeing such an uptick in people actually setting up estate plans? Because over the last 2 years, I've done over 500 estate plan signings. So obviously, it's something there, and people being proactive about it. What do you think is such an uptick in the market?
Yeah, I think the information is getting out there one way or another. I give a number of seminars where I kind of give people a spiel about estate planning, and I know that's a popular method for estate planning attorneys to get the word out there about this whole process. And I think there's also been aided by social media, little clips where you find people talking about whether it's business entities or whether it's estate planning. People are kind of finding out that information more easily. It's easier to get in the know. There are a number of ways that people are finding out, financial advisors, CPAs, these people that are focused on advising their clients on risk. If they're taking a comprehensive view of their clients' kind of portfolio and life approach, estate planning usually has to be one of the conversations that they have. It's definitely a part of a good financial plan. An entity is definitely a part of a sound business. And so you find these advisors that have insight into that. And so if they want to be good at their jobs, they usually end up having at least a conversation with their clients about it.
I see. So let's say for someone that wants to get set up, wants to get their estate plan set up, what are some common misconceptions that you don't normally come across? I know the one I always hear is, I'm not at a certain net worth. Some people think that they need to be either half a million or above to even consider having an estate plan. So what are some of those other common misconceptions?
Yeah, that is by far the biggest one, is that people think that you're supposed to be some multi-millionaire in order to require an estate plan. Now, keep in mind, there's a couple different, once you get to a certain net worth, estate planning takes on a kind of a different meaning. It's more about tax efficiency in addition to avoiding probate, but we're talking 13 million per individual at this point. That might go down to 5 million, but it's still significantly more than what the vast majority of people have. But that doesn't mean that those people that aren't worried about tax efficiencies shouldn't also be worried about probate, because like I mentioned earlier, the threshold for probate is 185,000, and that threshold goes down to 50,000 if you're talking about real estate. So there are a number of reasons to do it, even if you don't have that kind of money. And it's important for pretty much everyone, because at the end of the day, you don't want your kids to inherit some big headache. And that is likely what's going to happen if you have, any homeowner is in that zone. And even if you don't own a home, you want to make sure, you want to button up things like guardians for your kids. There are a number of reasons, or an advanced healthcare directive where you make known your wishes for what you want with your healthcare, or, the durable power of attorney where you know, deal with incapacity and who can manage your assets if you're no longer able to do so yourself. So there are a number of important reasons to. Sorry, Rafaniel, one moment, if you don't mind. Thank you.
We're back.
Sorry about that. Yeah, the perils of working from home, of course. So yeah, I think you know, the number one misconception is that, you know, it's not worth it. I don't have enough money. But you would be surprised how low the bar is for probate. You know, usually it's real estate valued over 50,000 puts you in the zone unless you have it in a trust. Or a lot of people think, you know, well, I'll put it as a joint tenants with my spouse, joint tenants with right of survivorship, in which case the spouse automatically absorbs the interest, which works temporarily, but all you're doing is kicking the can down the road, because when that second spouse passes, then you're going through probate. Or they think, why don't I put my kid on the deed now? Which sounds like it might work, but what you're forgetting is that now you're triggering reassessment of the property. And if you had low property taxes, the last thing you want to do is trigger a reassessment, and now you're paying, you know, God knows how much more in property taxes. So really the only like efficient way to do it, especially with real estate, is to set up a trust, which then allows you to designate who the beneficiaries are, make it as simple or complex as you want, and it allows you to name your successor trustees, whether that's a child or a family member or a professional fiduciary, somebody that can step in and manage those assets. And the process becomes so much simpler with dealing with it after than it would for probate.
It is also good for folks to actually just get something in place, like you said, like a power of attorney, along with the advanced healthcare directive and will. Because even then, if they just get something just at the basic, they do get to make like updates to their trust, and like they should do it like annually, correct?
Yes. So I mean, you know, a lot of people will set up a trust and they'll kind of forget about it for a while, which is, you know, it can work sometimes, but it's not usually advisable. You want to review it every, you know, maybe not annually, at least every couple of years, to get a sense of, has anything changed? Do I have different feelings about whether it's the trustee or the beneficiaries, or especially if you get new assets, you want to make sure, like if you buy a new home, you want to make sure that you're titling it properly so that you don't end up in the same problem you were trying to avoid to begin with. So it's always a good idea to check back in with your attorney and get a sense of, you know, am I still on track? Is everything still doing what I want it to do? And the power of attorney is more important than people think, because, you know, God forbid you get in a position where you're still alive but you're incapacitated. Life needs to go on. There are still bills that need to get paid. There are still accounts that need to be managed. And if you don't have a mechanism in place where somebody can step in and pick up that work for you, it's just a much bigger hassle to get those important items done. You know, whereas if you have a power of attorney, your child or your whoever you trust can step right in and start talking to banks and managing properties and managing accounts and doing what needs to be done in order to make sure that everything goes on.
Absolutely. Right. So let's say if we have someone who's heard of it, they know about what an estate plan is, they know why they need to avoid probate, they know they don't have to have a $500,000 or above net worth, and they're ready to get this set up or have the conversation. What steps would they need to take to be prepared before sitting down with you?
Yeah, I mean, the different estate planning attorneys have different approaches. A lot of them, and I used to be one of these people, they'll send you home with like a 50-page questionnaire that says, tell me about every asset you've ever owned, and tell me about every family relationship, and tell me this and that. And I started finding that 90% of the information was unnecessary in virtually every scenario, and B, it really turned people off from getting it done, which is the most important part, is putting something in place. So I've moved away from long questionnaires. I usually set up one initial consultation, no cost, where I give them a high level overview of estate planning and why it's important. We chat about, their family a bit and their goals, and try to get a sense of what it is they're trying to get out of it. And then after that, I send an email with 5 or 6 questions that kind of get to the core of the important pieces. Of course, full names and birthdays and addresses and that kind of stuff, but also who you want to be your successor trustee, who you want to be your agent. Do you have any specific gifts you want to give? Do you have any different ideas about who you want your beneficiaries to be, or is it just a split between your kids? Do you have any additional restrictions? Like some people want their kids to get, or their beneficiaries to get, some money when they turn 25 and some when they turn 35, or they only want money to be used for a certain reason until they reach a certain age, like education or healthcare or whatever it is. So you can really make it as simple or as complicated as you want. I try to drill down to just those kind of essentials, and then I'll put everything together. I'll send it over. I'll have them review. They come back with any questions or revisions, and then we set up a meeting where they come into my office. And Rafael, you've seen how some of these meetings go. You've dropped by during the tail end of a couple of them, but we go over all the documents together. I put them up on the big screen. I have a TV sideways, and we kind of scroll through them almost provision by provision, and we chat about what each section does and kind of the highlights of the documents, and gives them a final opportunity to kind of drill down on anything they're not 100% certain of. And then we're signing. So I really try to make the process as simple as possible. From the time I get those initial answers from clients, I can usually have them signing documents by the following week. So I know a lot of estate planning attorneys have kind of a slower turnaround. Usually 3 weeks is kind of industry standard. I'm trying to simplify the process because, another thing is a lot of estate planning attorneys try to target high net worth individuals and get them into these structures that do require more investigation. That's not really my client base. That's not really what I'm looking for. I think every person, any person that owns a home, any person that has minor kids, any person that has some assets in California, they all need estate plans too. And they can make it as complicated or simple as they want, but at the end of the day, they got to put something in place. And I'm trying to help those people make sure that they get something in place, make sure that it's what they want, it addresses their concerns. And, hopefully down the line, they do get close to that 13 million threshold, in which case come back and let's see what else we need to do to kind of address those tax efficiencies. But for now, let's put something in place so that if God forbid something happens to you tomorrow, your kids don't end up stuck.
And that's what I like most about your process is the fact that you make everything so simple and easily digestible. Like you said, with the working with other attorneys, like I said, they send out the questionnaires and you're sitting there trying to figure out how do I fill this out? As opposed to where they sit down with you, you got the screen, we got everything. We're able to go through this together. So if any question that you have, you don't have to get me on the phone. You don't have to send me an email like I've seen with other attorneys. They right there with you, answering any question that they have. So that way that the experience is positive and they feel comfortable with getting that estate protected. So
yeah, thank you.
I like that approach that you take.
Thank you. Yeah, I appreciate that. Yeah, and I think my clients are, they're leaving happy, and I'm really trying to let them know that at the end of the day, I'm not just advising them on these kind of tight-knit estate planning issues. I want them to know that I'm their attorney. Like if they have issues, they should reach out to me. And if I can't help them, I'll help them figure out who can. Because at the end of the day, I always admired kind of Robert Duvall's character in The Godfather, the consigliere, the trusted advisor. And I learned this early on in my career that clients don't really have legal problems. They have personal problems or they have business problems. And they just, at the end of the day, they want to figure out the easiest or quickest or most efficient way to resolve that. And they're not thinking about it in these defined legal questions that sometimes attorneys get into. No, they have a problem and they want to figure out how to solve it. So I always try to position myself as that kind of attorney. Like, call me. I've moved away from billable hours as much as I physically can. Everything is flat fee. There's no, I don't want to have this pressure where a client is thinking, did this guy just bill me $50 to ask me about my weekend? Like, no, let's have a conversation. I'd love to learn more about you and what's going on. And a lot of times I don't even, I don't bill for phone calls. I don't bill for a lot of these conversations. A lot of times I place them with other attorneys and I do some mediating and kind of stay on the emails to make sure they're getting what they need. And I try my best in most circumstances to never charge for that. So I want to position myself in that way. And I think people are responsive to it. They're leaving happy. They're reaching out when things come up. They're recommending me to their friends. And so I think that's a good insight into the fact that things are going well.
I appreciate that. I like that. Now, with you, I want to transition over to the business law side of things. So I know we have, like I said, we have an audience of notary entrepreneurs. I do a lot of consultations with new notaries. And a typical question that I always get is, how should you set up your business? Do I set it up as a DBA, LLC, S Corp, C Corp? Me, when I first started off, I didn't really have too much intel, so I just try to do as much research as possible. That was almost 7 years ago. I started off as a DBA. Now that was just when it was just myself. I'm the business model, per speak. But when I actually transitioned the business model into where we're hiring notaries nationwide, that's when I decided to do an LLC. So obviously, everyone's situation is going to be different. But what's the best piece of advice that you can give an entrepreneur right now, as far as what the best step that they should take in knowing how they should set up their business?
Sure. Yeah, absolutely. So there's no kind of one size fits all advice. It really depends on the business, but the best way to view it is from kind of a risk standpoint. So if you just go and open a lemonade stand tomorrow, you are considered a sole proprietor. There is no, if something happens, if you serve poisoned lemonade and somebody comes and sues you, there's no line between what is the lemonade stands and what is yours. So if it's a big lawsuit that's successful, they might foreclose on your house. So a lot of people, that scares them from getting into business. And so we created these structures, these entities, in order to let people feel more comfortable getting into business for themselves. So the more you have potential risk in your business, the more it's advisable to form some type of entity where you can limit your liability. So as a sole proprietor, or as a partnership, which is just a sole proprietorship with two or more people, there's no limit to that liability. You can go and get a DBA, which allows you to use an alternate name as the name for your business, but there's no shield. Whereas if you form a corporation or you form an LLC, and there's a big caveat here, and you treat it like a separate entity. So that means you maintain books and records. It has its own bank account. There's no commingling of funds. If you're a corporation, you're doing your annual minutes or more often, depending on what you're doing. If you're an LLC, you're doing your filings. You're keeping your bank accounts separate. You're treating it like it's its own company, and you're properly funding it. Then you get to enjoy this limited liability, where if something happens and you get sued, well, they can bankrupt your business, but if you did everything properly, they're not going to get to your personal assets. They're not going to foreclose on your house. They're not going to be able to get past what is the business's, assuming you do everything properly. So that's kind of the main draw of having an entity. People say, well, I could just get insurance. And that's true. Insurance can help you in a number of ways, but we've all dealt with insurance companies. A lot of them are in the business of trying to avoid claims where they can. And sometimes your coverage isn't the right coverage to fix a problem that you didn't necessarily know was that large. And there are a number of situations where insurance can put you in kind of a bad situation. That being said, everyone should have insurance, of course. Yeah. But from a liability standpoint, having an entity is really one of the best ways to limit your liability. And this is true of, like, for example, real estate investors. You know, they go and they buy properties and they set them up as rentals. Ideally, they would have an LLC for each property. That way, if they have an issue with a tenant, they get sued, a slip and fall, a landlord-tenant issue, whatever it might be, the last thing they want is for it to infect their personal life or even their other investments. So, like, ideally, you would do an LLC for each rental property that you have. That way, you isolate the liabilities, which is kind of the point. You want to isolate the liabilities so that if something happens, you're protected. You know, whether you want to select an S corp or an LLC, mostly it's dictated by tax concerns. And I would talk to your accountant or CPA about that, but they're taxed a little bit differently. S corps pay a tax based on net income. LLCs pay self-employment tax depending on how they're taxed, plus they pay a gross receipts tax, which is based on revenue. So depending on the structure of your business, one, you could end up paying more taxes than the other. I would consult with your CPA or your accountant to get a sense of which is a better approach. From a liability standpoint, both should offer the same kind of limited liability. It's not like you have more protection under an S corp than an LLC. The difference is that in an LLC, it's easier to follow, you know, what they call corporate formalities. Because with a corporation, you have to have your annual meeting minutes. You have to have president, secretary, treasurer. You have to have these different. There are more rules to follow in order to make sure that you're properly maintaining that limited liability. Whereas with an LLC, it's a lot simpler. You can kind of structure it however you want. So with a corporation, if it's like, you know, playing with blocks, an LLC is more like clay. You can have it look more like a corporation. You can have a manager. You can have it be member managed. You can have a board of managers. You can have a president, secretary, treasurer, or not. You can really set it up however you like. And because of that, it makes it easier to follow the formalities because you can set it up where there are fewer formalities required. Yeah. The third one, which we don't usually talk about as much, is a C corp. Mm-hmm. So C corp, the main drawback is that there's double taxation. So you get taxed as an entity, and then you get taxed as a shareholder on any distributions you get. So that, for people that are just kind of running their own small business, they usually avoid a C corp. C corps are more popular in instances where you're trying to get to some type of exit event like M&A or an IPO. In that instance, you might set up an entity that you're trying to grow. You're trying to grow the box and then sell the box, you know, as opposed to pulling cash out of it all the time. The vast majority of clients I work with either do an S corp or an LLC. Both are great options and definitely something worth looking into if you're going to run your own business, especially if there's any type of risk involved, especially if you're going to take on employees in California, for example. There's always risk of some type of employment claim, whether it's, you know, wage and hour or anything else that might come up in that context. You want to make sure that you're protected because those lawsuits can get pretty hefty pretty fast. They're complicated rules to navigate to make sure you're doing everything right. So I would definitely consult with an employment attorney. Maybe, I know there are a lot of these kind of outsourced HR companies that'll work with smaller companies that, you know, you pay a monthly fee and they're your HR department and they help you with setting up a handbook and hiring and firing and making sure that you're following all the rules around lunch breaks and other breaks that you have to give employees and overtime and all that stuff. It can get really complicated really fast, and you want to make sure that you're following all those rules. And the last thing you want is for someone to like that to result in you, you know, losing your house. That's always the worst case, the worst case scenario in that instance.
Yeah.
And I don't mean to scare people, but it's not necessarily the most common thing, but it's on the table. And as a good attorney, that's what you want to do, is you want to make sure people understand the potential risks from the worst to the smallest. So it's something to keep in mind, and you want to do it. You want it, whether it's an estate plan or whether it's a business, you really want to work with an attorney. You hear horror stories, as in both contexts. In the estate planning, people will think they're getting a good deal. Set up your estate plan for $750 online, and it's you're not working with an attorney. I don't want to name any names, but they spit out a set of documents and they send you on your way, and then they don't prepare the deed for you transferring the property, so the trust never gets funded. So it's as if you never did anything to begin with. Or in the business context, I had a client recently. They formed an entity 10 years ago by themselves. They just filed articles with the state and kind of forgot about it. And they never issued themselves stock. So that's kind of a big deal. When you create a company, you want to issue yourself stock, especially early when the stock is worth almost nothing. Yeah. If you wait, well, that stock is going to be worth something later, and then you're stuck with a large tax liability. And that's what happened. They didn't issue themselves stock off the bat when, it was 1,000th of a penny per share. Now it's more like $1 per share. And they're looking at, maybe $250,000 or more in a tax liability that they wouldn't have had otherwise. In order to save, $1,000 in legal fees, they ended up with this huge headache. And this is not, if it's not your business, it's always helpful to have somebody that knows the field to help you kind of navigate it, at least get you set up in the right way.
Mm-hmm. I think that's sound advice. Again, do your due diligence and always consult with the professionals is what I say. You've been giving us a ton of value just around estate planning, how to get your business set up, just how to just all around protect your best interests. A question that I always ask my guests is, where do you see yourself, or where do you see your firm within the next 5 years?
That's great. Yeah. So I think I've finally settled into a role that I can see myself doing for the next 30 years. When I was working at the law firm, it was, can I withstand this level of work enough to make partner? And then you make partner and you trade being at the top of one ladder to being at the bottom of another. And then you justify your compensation every year and you go out and try to get these large clients. And it just felt like this rat race that I was prepared for, but I didn't know if that's what I wanted for myself. And then going and working at an in-house counsel at a company, it was a great role, but also kind of similarly was I going to be doing this for somebody else for my whole life? Now working for myself, choosing who I work with, working in an area that I enjoy, running my business in a way that, analyzing it from, I've been a consumer much longer than I've been a business owner. So I have a sense of what I like and don't like when I interact with businesses. And I try to run my business in a way where, I avoid those things that I hated when I was working with other businesses. And so I finally have this setup where, I think I'll be doing this for the next 30 years or more. And I'm happy to do that. I don't do any marketing. All my business is from referrals. And so it's kind of a slow and steady growth where you build out your client base, and as their needs evolve, your practice kind of evolves a little bit too. And I'm just happy to be in this position that I think is very sustainable for me.
I love it. Before we head out, let the people know, where can they find you? Where can they get in touch with you so they can book a consultation to get their estate protected?
Absolutely. Yeah. I mean, call me 925-401-5096. Email me, Patrick at elahmadielaw.com. It's ELAHMADIE. Reach out and let's see if we're a good fit. I give initial consultations at no cost. I don't have other attorneys or paralegals or even an assistant working for me. I answer my own phone. Every call goes straight to my cell phone. And the number one complaint about attorneys is that they're not responsive enough. I usually respond, if not immediately, then within an hour or two. I'm always available for my clients. I can't tell you how many spam calls I answer every day just because I don't want to let a call go by. I'm always trying to make sure that I'm there at the drop of a hat. And so call anytime, email anytime. I'm available.
I'll make sure to have your information in the description as well, so our audience can reach out to you. Patrick, I want to thank you for jumping on the pod today. Gave us a ton of value. I hope the audience takes estate planning seriously. Tell their loved ones to get their planning set up, and don't avoid probate at all costs. Make sure you make sure you subscribe to our channel. If you're a notary that's watching this and you're looking to book more estate plan signing business, make sure you join our network. The name of my company is Stamper Signings. We're a nationwide notary service where we focus on scheduling signings nationwide. So make sure you hit the description, join our network. Again, Patrick, thank you. And until next time, have a great day.
Thank you so much for having me. And you're awesome, Rafaniel. Look forward to seeing you soon.